It's been something of a sleepless week, I think, for a lot of people in finance. And so the most fitting question, which I can't take the credit for, but I'll credit to Judith and her staff. We'd like to pose to everyone on the panel the simple question of, can you tell us one thing that's keeping you up at night, just to sort of get our macroeconomic discussion going. I think the protocol is to start with the public authority, so John Cunliffe.
Okay, thank you very much. For some reason, I've been given the clock, which I think...
You can send it here. Thank you.
Unless it's a very subtle hint. I was only going to talk for 30 or 40 minutes. I sleep pretty soundly, I have to say, and just as well, really. But the last few days, last few weeks, markets have become very gloomy, and I just wanted to talk a little bit about that and about the big picture. I mean, for the UK, the yield curve has fallen, and the markets now say that the Bank of England won't raise interest rates till the second quarter of 2019. That's about 2 years later than the markets were saying it would happen about a month ago. I can't see, I have to be honest, I can't see anything in the economic news over the last 3 or 4 weeks that would lead to a shift like that. And indeed, when you poll market economists, they still have an expectation of the bank moving at the end of 2016, this year. But clearly something has happened in the markets, and the question is, what does it tell us, and does it change the big picture in a way that would keep me awake at night? And there's a number of possible explanations, and they're not exclusive. One is simply that the markets are wrong. They're not the best predictor of the future, as many market participants know, to their cost. There's a possibility that we could be looking at what they call a bimodal world, that market yield curve isn't actually what anyone expects to happen. There's a central expectation that's closer to where the economists are of inflation and economies recovering, but there's also a fear out there that there might be a bad event about to happen, possibly out of emerging markets, and you put those two together in a bimodal distribution, and you get an average that actually isn't what people expect, but is the combination of the two. But there's also a possibility that markets have just become very gloomy about the world with a secular stagnation narrative, and the yield curve for the UK and for the US and for Euro advanced economies is pretty much flat as a pancake going out for a number of years, and that's just because they see low growth and entrenched low inflation as the new normal. My big picture of the world, I think, hasn't changed with the market yield curve. I mean, I think we are, and particularly in advanced economies, we are in a slow healing process from a financial bust. The academic literature tells you that's a long time. Reinhardt and Rogoff have it at 8 years, but I've seen different estimates. It's a long time because a financial bust builds up a misallocation of resources on the way in, and then it destroys the brain. I should hesitate to talk about the financial sector as the brain of the economy. That doesn't go down well everywhere you say that, but the financial sector is supposed to direct resources to the most productive use. And when that brain first freezes and then is broken, the economy suffers, and you get scarring effects and loss of investment. And in this slow healing process, we've had a number of big holes in the road. It started with the financial crisis in 2008-9, but that then triggered, though it didn't cause, the euro crisis that followed. And now we're seeing maybe not a crisis, but strain in emerging markets, which is in part due to some of the action taken to deal with the original recession following the financial crisis, credit expansion in a number of countries, and the impact of QE, I think, that's gone in. So one has slow healing and holes in the road. And if I look at the UK, the employment data yesterday showed vacancies at a record high, job-to-job transfers near to pre-crisis highs, unemployment at 5.1%. All of that, a healthy labour market, consumer confidence and business investment high, but productivity still not recovered and pay still stuck and not recovering. And I put those two things together and I see this slow recovery story. But there is this other story. There is a story that actually the productive potential of advanced economies is really much lower than we thought before the crisis, and actually has been damaged further, and that low inflation will become entrenched in a very difficult way, and layered on top of that risks of very hard landings in emerging markets at a time of fragile market liquidity. I think we've all taken some of that into our thinking. Quite interesting. Look at the IMF forecast. Pretty much every year for the last 8 years, they start with a forecast which has the world economy getting back to pre-crisis 4% plus after 3 years, and then somewhere around about the middle of the year, it comes down again. And now even the 3-year point has come down. They're no longer forecasting above 4%. So I think we've all taken that. We've all taken productivity and the fact we won't recover the lost productivity into our thinking, and also some secular decline in interest rates. But for me, I think I'm still sticking with the long cycle following a financial bust and a healing process that is painful, taking time, with risks and bumps in the road. I'm not quite bought in to the secular stagnation story yet. Thank you.
So a mixed picture in some ways, a menu of nightmares, but a longer-term possibilities that I think we can explore. Maybe choosing from that menu, turning to Axel Weber, you can expound on of those items what most preoccupies you, or take us and add to the menu, if you will, as you wish.
I'd like to follow up on what John said about the mood and where we think we are. So if I look at, and I usually make the distinction between sort of what happened in sort of changes and where we are in absolute levels. And I think too much attention is actually given to changes that happen over a short period of time, and too little focus is where do we stand in absolute terms. So if I look at last year, first glance, it didn't look that bad. Question was really what keeps us up at night. What keeps me up at night is more a deep look on where we are in terms of absolute levels. And unemployment came down slightly. The economy grew 1.5% annualized in the Eurozone. Government deficits have declined. So that doesn't look that bad. But when you actually look at something that doesn't look that bad, why does it still feel so bad where we are? And I think the real issue is that if you look at changes, you're sometimes misled. If you look at the underlying variables, it still shows that a lot of things are still in pretty bad shape. Eurozone GDP is still 0.3% below pre-crisis level. The GDP in Italy, for example, is 9% below pre-crisis level. GDP in absolute levels in Italy is back to where it was in the year 2000. So you could talk about 15 lost years in terms of not growing. And if you look at countries like the US, GDP grew over 10% since the crisis, 10% up on pre-crisis level. Swiss GDP is 8% up. And if you take a reference point in your perception where we are, take the level to which we got before the crisis. One reason why things don't feel good is in many indicators, we're still fighting to get back to where we were before the crisis. Some countries, some companies, some areas have actually left the crisis behind them, and the pre-crisis levels are no longer a reference point for them. If you're in the US, one of the reasons why the US has a good mood is on almost any indicator, stock prices, employment levels, they're actually even beyond where they were before the crisis. So things feel better because they are better in relative terms. If Europe looks at the crisis as the benchmark against which to judge mood, I'm not surprised a lot of people feel that things aren't as good. Take the unemployment rate. Unemployment rates were equal just after the crisis in Europe and in the US. For two reasons. Europe held up quite strongly in the crisis because we didn't have a deep crisis initially, we had it later. And US unemployment rate moved from 5% to almost 10%. European unemployment rate was at 10% at the time, but unemployment in the US is actually below where it was pre-crisis levels again. So even in the labor market, things feel better in the US. There's jobs generated. The US generated a total of 3 million jobs since the crisis. Europe, 2 million jobs have disappeared. So whenever you look at the delta, the absolute levels of activity, unemployment, where stock markets are, how banks have healed, all of these issues Europe still is fighting the crisis and is trying to regain the ground that we were at before the crisis, where the US at the other extreme has largely left that behind that, and the crisis is no longer a reference point. So one of the things that I'm concerned about that really keeps me very concerned is how do we re-engineer a world where people are looking at the last financial crisis as a remote past, but not as something that is a benchmark for the future. And I think as long as you compare yourself to that benchmark of the crisis, people really feel there's a lot of work to do. And unfortunately, the mood around Europe is that if I look at current activity, if I look at the migration issues, there's so many additional problems that we need to solve rather than getting just back to a level of activity before the crisis, that I'm not surprised, just having traveled a week on the West Coast in the US, that many US investors look at Europe in a very simplified way. If you want to buy into growth, that's the story you hear, buy into the US. If you want to buy into tech growth, which what Commissioner Oettinger talked about, buy into the West Coast of the US. If you want to buy into growth driven out of dynamics of population, which are not very good in Europe, which are somewhat better in the US, but which are great in Asia, buy into Asia. If you want to buy political risk, buy Europe. If you know how to risk manage political risk, you may actually do quite well. But show me the financial investors that know how to risk control and manage political risk. It's the one thing financial investors have probably the least experience. So the problem is that Europe, in the perception of what keeps Europe behind, it's much less the underlying corporates. We heard about it from our economists. The investment climate. It's much more the political environment being perceived as a risk factor, much more than in other constituencies where policy is not viewed as very often as a risk factor. And that's something for Europe to change. I think there are good chances we can change that. Other countries are moving in the same direction. If you look at the US election campaign, don't tell me there are no political risks around sort of the management of the largest economy in the world. If I look at some of the corrections we've seen in the Chinese markets, political issues, become important there as well. So it's very important that Europe, in getting its act together, moves beyond the perception of Europe being a risky place to invest because of political and other issues, and becomes a place that is interesting to invest because of a dynamic market and of good companies and of moving forward. And we need to create that perception, but it's only possible if we lose the perception that the crisis is still the benchmark to which we're trying to, pre-crisis level is the benchmark to which we're trying to manage.